On July 4th, 2025, a savings program for kids was signed into law. It's called a child savings account, also known as a Trump savings account, and it could change the way families think about saving for their kids' future. Now, keep in mind, this law is brand new. Some details may shift as the government fine-tunes how these accounts will work. So I'm not giving you tax or legal advice here, just sharing what we know so far about the Trump savings account. All kids under 18 can have the special savings account. But every U.S. citizen born between January 1st, 2025 and December 31st, 2028 will automatically qualify to receive a $1,000 starter deposit from the federal government. Things are a little different for kids born before 2025. Starting July 4th, 2026, children under age 18 can voluntarily open a Trump account. Let's say a baby is born on July 5th, 2025. As soon as that child's Social Security number is issued, the government automatically drops $1,000 into their Trump savings account. On the flip side, imagine a 16-year-old in 2025. Yes, they may also qualify, but they won't get the government seed money. The difference comes down to whether the child falls inside or outside of that pilot program birth window. Also, the exact process for older kids hasn't been fully worked out yet. That's one of the big questions still hanging in the air. Please keep in mind, the child is the actual owner of the account. They're not just listed under a parent's name. They're officially the account holder, or what's called the beneficiary. To qualify, your child needs to meet 3 requirements: be under 18 years old, be a U.S. citizen or resident, have a Social Security number with at least one parent who also has a valid SSN. And if the child is a newborn, only parents or guardians can actually open the account for them. And here's the part parents will love. Once your child's birth is registered and they're issued a Social Security number, the government will automatically set aside $1,000 for your child. Here's the interesting part. Parents may not always have to do the paperwork to set up the actual account. If the Treasury Department sees that a qualifying child doesn't have an account, the law gives them the authority to open one automatically on that child's behalf. Parents can still opt out later if they choose to, though. But most kids will literally start life with money already invested in their future. Now let's talk about how money actually gets into a Trump savings account. These accounts can be funded by parents, guardians, relatives, friends, employers, and even certain government programs or charities. Each year, up to a combined $5,000 can be contributed for each child. Starting in 2027, the yearly contribution limit will be adjusted for inflation, which means the cap could go up a little bit each year. Here's the breakdown. Parents and others can contribute toward that $5,000 total, and employers are allowed to chip in up to $2,500 per year for an employee's child under 18. The employer's share is included in the $5,000 cap. Up to $2,500 per year won't count as taxable income for the employee. Think of it like another job perk, similar to health insurance or other benefits. And here's some good news. That first $1,000 government deposit doesn't count against the limit. As a matter of fact, contributions from states, certain charities, or the U.S. Treasury aren't subject to the $5,000 limit at all. But when they make deposits, they have to apply them to specific groups, like every child born in a certain year, or every child in a specific state. One important thing to note, though, is no contributions can be made until a year after the law went into effect. Since it was signed on July 4th, 2025, the earliest you can make a contribution is July 4th, 2026. Until then, parents just need to wait and watch as the program takes shape. Trump account contributions must be made by December 31st of the year you want them to count. There is one exception. In the year the child turns 18, the account converts into a traditional IRA. From that point forward, contributions follow the IRA regulations, meaning you can contribute up until the tax filing deadline for that year, not just December 31st. Just like a traditional IRA, any investment earnings inside the account grow tax deferred. That means you won't owe taxes while the money is growing, but withdrawals later in life will be taxable. Missing the contribution deadline, whether December 31st before age 18 or the IRA deadline after, means you lose the opportunity to contribute for that year. Also, contributions to a Trump account are subject to the annual gift tax exclusion. For example, in 2025, the exclusion is $19,000 per donee. If you're already using your full exclusion to fund a 529 college savings plan for the same child, any additional gift to their Trump account could push you over the limit and trigger gift tax, unless you have unused estate, gift, or GST exemptions to offset it. Here's a quick example. Imagine a grandparent gives their granddaughter the full $19,000 in 2025 to her 529 college plan. Later that year, they also want to contribute $5,000 to her Trump account. Because the grandparent already maxed out the $19,000 exclusion with the 529 contribution, the $5,000 Trump account gift would count as an excess gift. Unless they apply part of their lifetime estate and gift tax exemption, that $5,000 could be subject to gift tax. The tax treatment of a Trump account depends on where the money came from. Parent, guardian, or individual contributions are made with after-tax dollars, so they create what is called the basis. That means when the money is withdrawn later, that portion of the withdrawal is not taxed. Employer contributions, the $1,000 federal seed deposit, and charitable gifts, these do not create basis. That means when withdrawn, they are fully taxable as ordinary income. For investment earnings, any growth in the account is tax deferred while it stays inside the account, but it becomes taxable when withdrawn. If you take money out before age 59 and a half, the taxable portion of the withdrawal may also face a 10% early withdrawal penalty unless an exception applies. Here's an important detail. The IRS does not let you pull out just the basis first. Instead, each withdrawal is split proportionally between taxable and non-taxable amounts. For example, suppose 40% of the account balance is from parent contributions, which is your basis, and 60% is from employer contributions and earnings. If you withdraw $1,000, then $400 would be tax-free and $600 would be taxable. That's why it matters who contributes, because a parent's gift could come out tax-free, while an employer's deposit or the government's $1,000 starter fund will be taxable later on. Since Trump accounts are meant to grow until your child becomes an adult, generally no money can be taken out before January 1st of the year the child turns 18. But there are a few exceptions. The entire balance can be rolled over into another Trump account for the same child. At age 17, the account can be rolled into an ABLE account if the child has a qualifying disability. If too much money has been contributed, the excess can be refunded, and sadly, if the child passes away, the account can be distributed to their heirs. Once the child turns 18, the account officially shifts into a traditional IRA. From then on, all the normal IRA regulations apply. This means the child must have earned income to keep making contributions. The account now follows all the usual IRA rollover, transfer, and aggregation rules, including the 1 per year rollover limit and required minimum distributions later in life. And early withdrawals before age 59 and a half could face a 10% penalty in income taxes unless an exception applies. A couple of exceptions are paying for college tuition, which has no limit, or using up to $10,000 toward a first home. Here's an example. You put $2,500 into a Trump account every year for your son. By the time he's 18, thanks to compounding and low fees, the account has grown to nearly $60,000. If he later uses part of it for college, he can tap into that money without paying the 10% penalty, making his Trump account a powerful education fund as well as a retirement starter. So basically, the Trump account is like a stepping stone. It starts as a childhood savings tool, then graduates into a traditional IRA the moment that child becomes an adult. I mentioned penalties a few times already, but let's dig a little deeper into it. You have over-contributions. If more than the annual limit goes in, the IRS can hit the account with a 6% penalty every year until the mistake is fixed. The fix usually means pulling out the extra money plus any earnings on it. Too early withdrawals. Before the child turns 18, money generally cannot be touched except in the very limited exceptions I mentioned earlier. Post-18 penalties. Once the account becomes a traditional IRA, pulling money out before age 59 and a half could mean a 10% penalty unless you qualify for an exception, like using the funds for college expenses or a first-time home purchase. For example, your child's grandparents are excited and decide to put in $6,000 into a Trump account one year, not realizing the limit was $5,000. That extra $1,000 could trigger a 6% penalty every single year until it's fixed. So as the parents, you step in, withdraw the excess plus a few dollars of earnings, and the account is back on track. That's why knowing the limits and deadlines is just as important as making the contributions. A little mistake could eat away at the account's growth. Now, Trump accounts won't be scattered all over the place. They'll be held with government-approved financial institutions, just like other retirement-style accounts. And Trump accounts can only be invested in certain kinds of mutual funds. The fund must track a broad index like the S&P 500 or another index made up of mostly U.S. companies. It can't be tied to just one industry or sector, so no tech-only or energy-only funds. And it can be based on market size. large cap, mid cap, small cap, but the annual fees have to stay under 0.1% of the balance. In other words, the account is designed to grow steadily without high fees or risky bets. Every Trump account will come with strict reporting requirements. The financial institution that holds the account has to send annual reports both to the IRS and the account owner. These reports must include total contributions made and the source of any contribution over $25 if it comes from someone outside the family, distributions and rollovers, the current account balance, and the amount of basis in the account, which is the part that won't be taxed when withdrawn. This level of reporting continues each year until the account becomes an IRA. After that point, the account is reported under the same system used for traditional IRAs. At the end of the day, the major incentive for the Trump account is the $1,000 starter deposit from the federal government, plus any extra contributions an employer or charity might add. That's free money, and you should always take advantage of it. But when it comes to putting in your own contributions, it's worth comparing your options. For some families, a 529 plan may be a better fit, especially if the primary goal is college savings. Why? Because 529 plans allow tax-free withdrawals for a wide range of educational costs, and under the latest tax regulations, those qualifying expenses have expanded even further. Plus, unlike Trump accounts, 529 balances don't weigh as heavily against your child's ability to qualify for financial aid. On the other hand, Trump accounts may appeal to families with broader goals, things like saving toward a first home, covering vocation training, or just giving a child a jump start on retirement savings. With the $1,000 seed deposit available for kids born between January 1st, 2025 and December 31st, 2028, it offers a unique head start no other account provides. For many families, the best approach may be a mix, using a 529 for education and the Trump account for more flexible long-term goals. By the way, there are a lot of new tax changes this year. If you'd like to learn more about other new federal tax changes that could affect you and your family, please click on the video in the upper left of your screen. All the best to you.